Some Canadians go their entire career without fully understanding how much money they're making, and I fundamentally believe that the reason why that is because they don't even know how to properly read their pay stub, and I don't blame them. I've seen so many of these things with lines, abbreviations, and numbers that I don't even understand, and I've been helping people with their money for the last 7 years. The problem is, without a full understanding or grasp on how much money you're making, it's very difficult to actually make progress with your finances or even build wealth. So today, I'm going to break down everything that may show up on your pay stub so that you can start to understand how much money you're making, how much money you might be losing, and what are the right steps to take in order to increase and maximize your paycheck. Hey folks, if you are new here, my name is Aaron. I'm a certified financial planner, independent wealth advisor, and university instructor where I teach personal finance. And over the course of the past 7 years, I've been helping high-performing Canadians just like you maximize their potential and become the wealthiest versions of themselves. And I wholeheartedly believe that one of the first steps in order to do that is understand how much you are getting paid, and that begins with a paycheck and a corresponding pay stub. So let's dive into it. What we're going to go through here is a sample pay stub that I received from one of my clients, and it's one of the more complicated ones that I've seen, so I highly encourage you to pull up your most recent pay stub so you can compare some similarities and some differences. All right, so before we get into the numbers themselves, it's important to understand what your pay stub actually represents. And basically, it's the amount of money that you've been paid during a specified period of time. So you're going to have your pay period up here, and then usually it's going to be broken down into the pay period and then the actual year to date that you've accumulated for that particular category or line on your pay stub. Now, I know this may seem kind of obvious, but you'd be surprised the number of times I come across people who are kind of concerned or confused because they've been working a bunch of overtime or they closed a large commission or sale recently and it's not represented on their pay stub. But most oftentimes, employers pay their employees anywhere from like 5 to 15 days after their pay stub period ends. This means that everything that's listed on this pay stub is only representative of what happened during that particular time period. Heading into the actual numbers themselves, the first section is going to be the earnings section. And depending on your pay stub, this may be as detailed or as simple as can be. And in this particular case, it's fairly detailed. But regardless, this is going to be the line or the lines that represent your gross pre-tax earnings that you've earned during this pay period. And if you're on a flat salary, this will basically be as simple as taking what was on your offer letter and dividing that up by the number of pay periods that you've been paid over the course of the year. Now, sometimes it's broken down nicely, just like how it is here. Well, I wouldn't say nicely, but it's broken down in fair detail where you're going to be able to see kind of what your base pay was, but then you're also going to see any sort of commissions or overtime in this case that you would have earned on top of this. In this particular case, this person is a nurse, so you can see what her regular base pay is, and then you can see any sort of overtime earnings, and then there's also earnings that, she gets a premium per hour based on, working evenings, weekends, or the night shifts. Now, a quick side note, this is also going to be the area where you're going to see any sort of commissions or bonuses paid out. And I've had a number of people kind of concerned or come up to me and they're kind of worried because it looks like based on their pay stub that their bonuses or their commissions are being taxed at a much higher rate than kind of their regular base pay. And I'm here to put your mind to ease because that's not actually the case. Most payroll systems work in a way where they estimate the annualized earnings from that period and then apply taxes based on that. What that means is that, if you get a large bonus of, let's say, $10,000 or $15,000, the payroll system that your employer is likely using is going to calculate the amount of taxes to take on that portion off based on if you were going to get that bonus or that commission or whatever paid out every single pay period, which obviously that would push you into a much higher tax rate. And being pushed into a much higher tax rate results into a much larger withholding tax. And withholding tax is this calculated portion of your income that your employer takes off and sends to the CRA on your behalf. And usually, especially if this commission or this bonus is kind of like a one-off, when you reconcile everything and you file your taxes around tax time, you usually get that portion that you overpaid back on your tax return. Next up, we are moving on to the deductions, which is further broken down into statutory and then other employee deductions. One pro tip here, anytime you see a line that says the letters EE, that is basically representing a dollar amount that is coming out of your pocket. And then anytime you see the letters ER, that represents a dollar amount that's coming out of your employer's pocket. First, we have income tax, which is likely going to be your largest deduction because, we live in Canada and we have to pay taxes on any sort of income that we earn. And in Canada, we operate on a progressive tax system. And if you want kind of more details on what that means or how much you particularly are going to be paying in taxes, I would go to taxtips.ca, find your province, and then see how much, you can estimate based on how much you expect to earn kind of this coming year or this year itself. Now, once again, this is calculated by most payroll systems based on an assumption that your current period, will be the amount that you're going to be making annually. And then that calculation will tell the employer to take that much off of your paycheck and send to the CRA on your behalf. One thing a lot of people don't know is that you can actually have less withholding tax taken off of your paychecks every period. And all you have to do is go to the CRA website, print off and fill out the form T1213, submit that to your employer, and then after that, you should have less withholding tax taken off. A word of caution though, because you're having less withholding tax taken off from your paychecks every month, you might have a larger tax bill at the end of the year or when you file your taxes, because the amount that was calculated in terms of how much taxes you owed is actually way more than what you would have paid during the course of the year. Next deduction we have is CPP. This is the Canadian pension plan, and basically all Canadians with an earned income have to pay into it based on a percentage, and at the time of this recording, it's 5.95% of their earnings up to a maximum earnings of $68,500 at the time of this recording. Now, this is why if you make more than this later on in the year, your paychecks would actually look larger because you've finished paying into this up to that maximum $68,500 threshold. Now, I want to reiterate, this is not your employer's pension plan. I ask a lot of people if they've got a pension through their work, and they say yes because they're paying into CPP. This is not through your employer. This is through the government of Canada, and it's mandatory for all Canadians with an earned income to pay into. It's a government pension plan that you pay into, your employer matches your contributions, and then when you retire, you begin to get a defined benefit for the entire course of the remainder of your life. There's limited flexibility with this. It's mandatory. Everyone has to pay into it. And in my opinion, that's a good thing. Working with tons of retirees over the course of the past few years, I've come to realize how much of a valuable benefit that this CPP pension is come when you retire. It makes up a large chunk of your income in retirement, and it allows a lot of Canadians to retire quite comfortably. A quick note on this here, you guys might have another line called secondary CPP, which, without getting into the nitty-gritty details, it's basically another CPP on top of your base CPP, where you pay a percentage of your earnings above the first threshold up to a secondary threshold. Next up, we have EI, which is employment insurance. Basically, you could look at this as a type of an emergency fund where you pay into it and your employer pays into it on your behalf as well. And then in a few cases, such as, getting laid off from work, or if you've recently had a baby and if you're on maternity leave, you're subject to a weekly payment. Moving on to other deductions here, these would be non-government deductions that are still mandatory. So as you can see, this person has access to a gym or a fitness facility at work, which costs money, and that comes directly off of a paycheck. She's also a part of a union. Now, unions have a lot of benefits to them. However, for the majority, they're self-funded. Which means that all of the members of the union need to pay these dues or these fees that are contributed to off of each paycheck, and that's represented right here on the pay stub. There's also a health and dental plan that costs money to this employee, and it comes directly off of the paycheck. Now, an important caveat here. The cost of these benefits plans can vary drastically from pay stub to pay stub or employer to employer, because in some cases, the employer will cover all or a portion of the costs attributed to these health and dental plans. But in some cases, there's a portion or all of that cost that lands on the employee. So if you are paying into it, this is a friendly reminder to use it up. Obviously, there's tons of research to prove that benefits are important, and it definitely lends to a better quality of life. Another note here is that if you, the employee, are subject to the entire cost of the benefits, this may be a significant deduction off of your paycheck. However, if you have a common law spouse or if you are married to someone else who also has a benefits plan through their work where maybe their employer is paying for a significant or entire portion of their benefits plan, it may be financially smarter to opt out of your benefits plan and then get onto their benefits plan as a supplementary coverage. I see a lot of people who don't understand their pay stub, who pay hundreds of dollars into these health and dental plans when they don't need to be, especially because their spouse may have a better or cheaper plan than they do. We also have a large deduction here that is for a pension contribution. Now, for a lot of Canadian healthcare workers, teachers, or anyone working in the public sector who have pensions through their employers, this is also going to be one of your largest deductions. This is basically an amount that you're paying into a pension plan, very similar to CPP, that your employer is matching. And then once you retire, you get to benefit from a bi-weekly or a monthly paycheck for the remainder of your life. Usually this is not optional, but from a financial planning standpoint, I think that's a good thing. You know, I read this from Stats Canada that in 2023, retirement age Canadians who had both an employer-sponsored pension plan and owned their home had a median net worth of $1.4 million. And, you know, those with neither had a median net worth of $11,900. And that drastic difference is simply through a forced savings plan through your work or through a mortgage or whatever it may be. Now, some deductions that aren't on this pay stub but may be on yours are any sort of contributions, optional or not, that may be going into some sort of RSP, TFSA, or other savings plan that you may have through your employer. Next up, we have taxable benefits that may or may not be monetary. So these are things like parking passes that your employer might pay for, any sort of non-educational conferences that they might send you to, or wellness accounts where you can spend on whatever, things like glasses or treadmills or golf clubs. And then we have employer contributions where, you know, detailed pay stubs will list out everything that your employer is contributing and matching on your behalf. And as you can see on this one, you know, we've got employer contributions to CPP, to EI, to the health and dental costs, the employer's portion of the pension, and then any sort of premiums for life insurance or disability insurance through the employer. And this is a very insightful portion of the pay stub here, in my opinion, because it illustrates the cost above and beyond your salary to the employer for having you as an employee. And then lastly, on your pay stub, you might have these notional accounts where, you know, you see running balances of things like banked overtime or vacation that you can either take as, you know, taxable pay, or you can get time off. So there you have it. I know that was a lot to go through. So if you're still here, I want to thank you for sticking with me right to the end. In a perfect world, all of these would be simple, easy to understand, and standardized, but unfortunately, we don't live in a perfect world. So hopefully you got a better understanding of how much you're getting paid. And if you want more actionable steps and insights towards building wealth as a Canadian, hit that subscribe button and I will see you in the next video.